As you watch the candlestick charts flicker wildly between red and green, as market rumors spread like wildfire, and as everyone around you either cheers for short-term gains or laments their losses, have you ever found yourself clenching your fists, torn between the temptation to chase highs and sell lows, and the anxiety of missing out? If so, then you need to discover the book that has rewritten the financial destinies of countless people. The Intelligent Investor. Its author, Benjamin Graham, was not only Warren Buffett's revered mentor, but also the father of value investing, who carved the path of reason through the treacherous landscape of Wall Street for over 80 years. The market has endured a dozen crashes and recoveries, and countless investment theories have burst like bubbles, yet this book alone, like ingots of pure gold tested by fire, has consistently shone with a light that pierces through market cycles, whether you're a novice who has been burned, or a veteran who loses sleep over volatility. The moment you open it, you'll suddenly understand that true investment wisdom is not about the magic of predicting the market, it is the art of navigation that allows you to stand firm on the deck amidst a raging storm. Have you ever had an experience like this? You see a colleague's stock soar for 3 weeks straight. During every lunch break, they are talking about making another month's salary. You can't resist any longer and jump in right before the market closes on Friday, only to be hit by a major drop the following Monday, leaving you with a 10% paper loss. Or perhaps you're holding a stock. The company's financial reports show profit growth and healthy cash flow, but the market suddenly plummets due to negative industry rumors. You watch the numbers in your account turn ugly, staying up until 3 a.m. scrolling through financial news, and finally, at 5 a.m., you panic sell, only to find you've sold at the absolute bottom. A week later, the price quietly creeps back up. In reality, this cycle of chasing highs and selling lows is nothing new. Graham documents an even more extreme case in his book. In 1938, the stock of the Great Atlantic Pacific Tea Company, AP, fell to 36 a share. At the time, the company held $85 million in cash and had net assets of $134 million. In other words, buying the stock was like getting the company's factories, stores, and business for free. Yet, due to short-term performance fluctuations and industry panic, the market had pushed its price to an absurdly low level. At this point, you might wonder, why would the stock of a perfectly good company fall so dramatically? Why do so many smart people turn into suckers the moment they enter the stock market? Graham pinpointed the key issue back in the first edition of his book in 1949. You will not make money if you are always doing the obvious or what everyone else is doing. The problem is, why can't we resist doing the obvious? Why do we know the principle of buy low, sell high but always seem to do the opposite in practice? Behind this lie two fundamental conflicts, which are the focus of our discussion today. First, we often confuse speculation with investment, thinking that buying stocks is about making a quick buck, while forgetting that the essence of investing is buying a piece of a business. Second, we are too easily swayed by market sentiment, mistaking price fluctuations for changes in value. We become like passengers screaming on a roller coaster, forgetting that our goal is to reach a destination, not just to be tossed around by the ride. Those chase high, sell low actions we just talked about might seem like bad luck, but they are actually rooted in 3 cognitive traps that are difficult to avoid. These are the core problems Graham identified over 50 years of observation. Trap 1. Confusing speculation with investment and not understanding what you're doing. Graham provides a piercing definition in his book. An investment operation is one which, upon thorough analysis, promises safety of principal and a satisfactory return. Operations not meeting these requirements are speculative. Think about it. When you buy a stock, do you calculate the company's profits over the last decade and how much cash it has on hand? Or do you simply listen to an influencer who claims the stock is about to surge? In 1962, the U.S. stock market witnessed an absurd phenomenon where many new IPOs were hyped to astronomical prices. For instance, a company called Aetna Convertible Industries was issued at 9 in 1961 and quickly rose to 15. However, its net asset value per share was only 1.20. The stock later plummeted to 0.875. Buying such a stock is essentially gambling, yet it was packaged as investing. Trap 2. Being led by Mr. Market's emotions, mistaking price for value. Graham created a famous allegory. The market is like an emotional business partner named Mr. Market. Every day, He comes to you with a price quote. Some days he's euphoric and quotes a sky-high price. Other days he's despondent and offers a rock-bottom price. The problem is many people treat his daily quote as the true value of the company. Take the APT company in 1938. Again, the stock price fell to 36. But the company's cash and liquid assets alone were worth 72 per share. At that moment, Mr. Market was panic selling and essentially giving money away, yet most investors followed his lead and sold, which is like seeing someone jump off a building and deciding to jump too. Trap 3. The unavoidable human weaknesses of greed and fear. Why do we do the opposite of buy low, sell high in practice? Because when you're greedy, you think, just a little longer, it can go higher. When you're fearful, you think, if I don't sell now, I'll lose everything. At the peak of the great bull market in 1929, everyone was saying, this time is different, believing the market would rise forever. Even shoeshine boys were giving stock tips. By the bottom of the bear market in 1932, no one dared to buy stocks, even when many companies were trading for less than the cash on their books. Having lived through both extremes, Graham concluded, human nature is fundamentally the same, so the difficulty of prudent investing will always be related to the investor's temperament. At this point, you might be thinking that these traps sound impossible to avoid. Isn't there a system to navigate around them? In fact, Graham already provided the answer. He designed 2 distinct strategies for different types of investors, enabling them to both protect their principal and earn a reasonable return. This is what we'll discuss next. What are the specific steps to becoming an intelligent investor? Now that we know the common pitfalls, we can find the right remedies. Graham designed 2 clear strategies based on an investor's risk appetite and the amount of effort they are willing to put in. Whether you want to preserve your capital safely or actively seek superior returns, there is a framework for you. If you are a defensive investor, your motto is safety first, profit second. The core objective is to avoid significant losses and outperform inflation. How do you do it? Method 1. Stock-bond balance for automatic stability. Allocate half of your funds to high-grade bonds, like U.S. Treasuries or top-rated corporate bonds, and the other half to large-cap, blue-chip stocks, such as companies in the Dow Jones Industrial Average. If the market rises and your stock allocation exceeds 55%, sell some stock and reinvest in bonds. If it falls and your stock allocation drops below 45%, buy more stock to rebalance. This automatic rebalancing forces you to sell high and buy low, countering the instinct to chase trends. Method 2. Stick to old friends, avoid new hypes, choose large, industry-leading companies that have a history of continuous dividend payments for at least 20 years. Strictly avoid stocks with a P/E ratio over 20. In the 1960s, many growth stocks were bid up to P/E ratios of 50 or more, only to crash later because their valuations were too high, leaving no margin of safety. Method 3. Don't overtinker. Look at your portfolio less. The best thing a defensive investor can do is to set it and forget it. After selecting your assets, reviewing your financials, and rebalancing your portfolio once a year is sufficient. If you are an enterprising investor, your goal is to find bargains and profit from the market's mistakes. The core objective is to achieve returns slightly above the market average, but only with manageable risk. Here are the key tactics. Tactic 1. Buy large, unpopular companies within an index like the Dow Jones. There are always a few companies that have fallen out of favor due to short-term performance issues, causing their P/E ratios to be significantly lower than their peers. For example, in the 1950s, U.S. steel stocks had a P/E of just 10, well below the industrial average of 15. When their performance eventually recovered, so did their stock prices. Tactic 2. Buy stocks below their liquidation value. If a company's current assets, like cash and inventory, minus all its liabilities are greater than its market capitalization, you are essentially getting its fixed assets and business operations for free. Tactic 3. Avoid hot IPOs. An enterprising investor can buy growth stocks, but must wait until their price returns to a reasonable range, for instance, when the P/E ratio falls below the industry average. By now, you may have noticed that whether you're defensive or enterprising, the core principle is the margin of safety. These 3 words perfectly encapsulate the essence of investing. It's not about guessing market direction, but about finding opportunities where the price is below the intrinsic value It's not about competing to see who gets rich quicker, but about ensuring you don't suffer devastating losses. The margin of safety acts as a protective cushion for your investments. Much like the foundation of a building must be stronger than the structure itself to withstand an earthquake. When buying a stock, you need a margin of safety. Either its P/E ratio is far below its historical average, or its tangible assets are worth more than its market cap. When buying a bond, you select issues with high interest coverage ratios, such as a company whose annual profit is more than 5 times its interest payments. Graham lived through the Great Depression of 1929 and saw countless investors go bankrupt because they left no room for error. He said, "Risk cannot be eliminated, but it can be successfully reduced if we keep it clearly in mind. The essence of investing is to be part of the rational minority. When others become euphoric in a bull market and ignore risk, the intelligent investor asks, do this company's profits really support such a high stock price? When others are panic selling in a bear market, they ask, is the company's cash flow still healthy? Are its assets now undervalued?" This reflects a deeper life wisdom, not being controlled by emotions, not being sidetracked by short-term temptations, and viewing things from a long-term perspective. After reading this book, you'll find that investing is never just about buying and selling stocks and bonds. It's a discipline of mastering one's own human nature, whether you are greedy, fearful, or patient. All of these traits will be reflected in your account balance, as Graham concluded in his book. Through all the vicissitudes and calamities of securities investment, sound investment principles will generally produce sound results. We must act on the assumption that they will continue to do so. So, the next time you make an investment decision, first ask yourself, am I buying this because it's truly worth the price, or because everyone else is buying it? Am I selling this because its value has genuinely declined, or simply because I am afraid? Once you can answer these questions clearly, you are already on the path to becoming an intelligent investor. After all, the market is never short of opportunities. What's scarce is a clear mind and unwavering principles.